Hi everyone, welcome to Finova, the channel that provides financial advice and tips for young investors. I'm your host, and today I'm going to share with you 30 ways to invest your money in your 20s. Why is it important to start investing early? Well, the sooner you start, the more time you have to grow your wealth and take advantage of the power of compounding. Compounding means that your money earns interest on interest, which can make a huge difference over time. For example, if you invest $10,000 at a 10% annual return, you will have $67,275 in 20 years. But if you wait 10 years to start investing, you will only have $25,937 in 20 years. That's a difference of more than $40,000. So how can you start investing in your 20s? There are many ways to invest your money, depending on your risk tolerance, return expectations, time horizon, and personal preferences. In this video, I will show you 10 ways to invest your money: stock market investing, alternative investing, passive investing, active investing, socially responsible investing, and global investing. For each way, I will explain the pros and cons and give you some examples of how to invest in them. I will also use some visuals, charts, or animations to make it more interesting and easy to understand. So let's get started. Stock market investing. Stock market investing is one of the most popular and accessible ways to invest your money. It involves buying shares of companies that are listed on a stock exchange, such as the New York Stock Exchange or the Nasdaq. You can buy individual stocks or invest in funds that hold a basket of stocks. Here are 5 ways to invest in the stock market. Way 1. Individual stocks. Individual stocks are shares of a single company, such as Apple, Amazon, or Tesla. You can buy and sell individual stocks through a brokerage account or an online platform. The main advantage of individual stocks is that they can offer high returns if you pick the right ones. For example, if you had invested $1,000 in Netflix in 2010, it would be worth more than $50,000 today. The main disadvantage of individual stocks is that they are very risky and volatile. You can lose a lot of money if the company performs poorly or goes bankrupt. For example, if you had invested $1,000 in Enron in 2000, it would be worth $0 today. Way 2. Exchange-traded funds, ETFs. Exchange-traded funds, ETFs, are collections of stocks that track an index, a sector, a theme, or a strategy. For example, an S&P 500 ETF tracks the performance of the 500 largest companies in the U.S. An energy ETF tracks the performance of companies in the energy sector. A thematic ETF tracks the performance of companies related to a specific theme, such as technology, healthcare, or cannabis. You can buy and sell ETFs through a brokerage account or an online platform. The main advantage of ETFs is that they offer diversification and low fees. You can invest in hundreds or thousands of stocks with one ETF and pay less than 0.5% in annual fees. The main disadvantage of ETFs is that they may not match the performance of the underlying index or sector due to tracking error or management fees. Way 3. Index funds. Index funds are similar to ETFs, but they are not traded on a stock exchange. They are mutual funds that track an index, such as the S&P 500 or the Dow Jones Industrial Average. You can buy and sell index funds through a brokerage account or an online platform. The main advantage of index funds is that they offer diversification and low fees as well. You can invest in hundreds or thousands of stocks with one index fund and pay less than 0.2% in annual fees. The main disadvantage of index funds is that they may have higher minimum investment requirements than ETFs and they may not be as liquid as ETFs. Way 4. Mutual funds. Mutual funds are collections of stocks that are actively managed by a professional fund manager who tries to beat the market by picking the best stocks for the fund's objective and strategy. For example, a growth fund aims to invest in fast-growing companies that have high potential for future earnings growth. A value fund aims to invest in undervalued companies that have strong fundamentals and low prices relative to their earnings or assets. You can buy and sell mutual funds through a brokerage account or an online platform. The main advantage of mutual funds is that they offer professional management and expertise. You can benefit from the fund manager's research and analysis and rely on their judgment and experience. The main disadvantage of mutual funds is that they charge higher fees than ETFs or index funds. You may have to pay up to 2% in annual fees and some additional fees such as sales charges or redemption fees. Way 5. Dividend stocks. Dividend stocks are shares of companies that pay regular dividends to their shareholders. Dividends are distributions of a portion of the company's profits, usually on a quarterly or annual basis. For example, Coca-Cola pays a dividend of 42 cents per share every quarter, which means that if you own 100 shares of Coca-Cola, you will receive $42 every 3 months. You can buy and sell dividend stocks through a brokerage account or an online platform. The main advantage of dividend stocks is that they provide a steady and passive income stream. You can reinvest the dividends to buy more shares or use them for your living expenses. The main disadvantage of dividend stocks is that they may have lower growth potential than non-dividend stocks. Companies that pay high dividends may have less money to invest in their business expansion or innovation. Alternative investing. Alternative investing is a way of investing in assets that are not traditional stocks, bonds, or cash. Alternative investments can offer higher returns, lower correlation, and more diversification than conventional investments. However, they also come with higher risks, higher fees, and lower liquidity than conventional investments. Here are 5 ways to invest in alternative assets. Way 6. Cryptocurrencies. Cryptocurrencies are digital currencies that use cryptography to secure transactions and control the creation of new units. Cryptocurrencies operate on decentralized networks called blockchains, which are distributed ledgers that record and verify transactions without the need for intermediaries. Some of the most popular cryptocurrencies are Bitcoin, Ethereum, and Litecoin. You can buy and sell cryptocurrencies through online platforms or apps such as Coinbase, Binance, or Robinhood. The main advantage of cryptocurrencies is that they offer high returns, low inflation, and global accessibility. Cryptocurrencies have surged in value in recent years, making some early investors millionaires or billionaires. Cryptocurrencies also have a limited supply, which means that they are not affected by the printing of fiat money by central banks. Cryptocurrencies can also be used to send and receive money across borders without intermediaries or fees. The main disadvantage of cryptocurrencies is that they are very risky and volatile. Cryptocurrencies can fluctuate in price by hundreds or thousands of dollars in a matter of hours or days. Cryptocurrencies are also subject to hacking, theft, fraud, regulation, and technical issues. Way 7. Commodities. Commodities are raw materials or agricultural products that are traded on exchanges or markets. Some of the most common commodities are gold, silver, oil, natural gas, wheat, corn, and soybeans. You can buy and sell commodities through futures contracts, options contracts, ETFs, or mutual funds. The main advantage of commodities is that they offer inflation protection and diversification. Commodities tend to rise in value when inflation is high or when the demand for them exceeds the supply. Commodities also have low correlation with stocks and bonds, which means that they can reduce the overall risk of your portfolio. The main disadvantage of commodities is that they are very risky and volatile as well. Commodities can fluctuate in price by large amounts due to changes in weather, supply, demand, geopolitics, or speculation. Way 8. Art and collectibles. Art and collectibles are items that have aesthetic or historical value and appeal to collectors or enthusiasts. Some examples of art and collectibles are paintings, sculptures, antiques, coins, stamps, wine, jewelry, watches, cars, sports memorabilia, comic books, trading cards, video games, etc. You can buy and sell art and collectibles through auctions, dealers, galleries, or online platforms such as eBay, Sotheby's, or Christie's. The main advantage of art and collectibles is that they offer aesthetic pleasure and emotional satisfaction. Art and collectibles can also appreciate in value over time, especially if they are rare, unique, or have historical significance. The main disadvantage of art and collectibles is that they are very illiquid and expensive. Art and collectibles can be hard to sell quickly or at a fair price. Art and collectibles also require high maintenance costs, such as storage, insurance, or restoration. Way 9. Peer-to-peer lending. Peer-to-peer lending is a way of lending money to individuals or businesses through online platforms that match lenders and borrowers. Some of the most popular peer-to-peer lending platforms are Lending Club, Prosper, and Upstart. You can lend money to borrowers with different credit ratings, loan purposes, loan terms, and interest rates. The main advantage of peer-to-peer lending is that it offers high returns and diversification. You can earn interest income from your loans and spread your risk across different borrowers. The main disadvantage of peer-to-peer lending is that it involves credit risk and default risk. You can lose your money if the borrower fails to repay the loan or goes bankrupt. Way 10. Peer-to-peer real estate investing. Peer-to-peer real estate investing is a way of investing in real estate properties or projects through online platforms that connect investors and real estate developers or owners. Some of the most popular peer-to-peer real estate investing platforms are Fundrise, Realty Mogul, and PeerStreet. You can invest in different types of real estate assets, such as residential, commercial, industrial, or land. You can also invest in different stages of real estate development, such as pre-construction, construction, or renovation. The main advantage of peer-to-peer real estate investing is that it offers access and exposure to the real estate market with low minimum investment requirements and fees. You can invest in real estate properties or projects that you may not be able to afford or access otherwise. The main disadvantage of peer-to-peer real estate investing is that it involves liquidity risk and market risk. You may not be able to sell your investment easily or at a good price. You may also lose money if the real estate market declines or the property or project fails. If you found this information helpful, don't forget to hit the subscribe button to stay updated with our future videos. Also, please give this video a thumbs up and share it with others who may benefit from it. Your support encourages us to continue creating valuable content like this. Thank you for watching, and remember that investing is a journey that requires patience, discipline, and continuous learning. Here's to your financial success.